today. We're talking about gold. You've got a stock market that's down. You've got bond yields that are lower. You've got a crisis in Ukraine where tensions are escalating. You think that buyers would be flocking into the gold trade, but they're not. Gold losing about 2% today. We are going to dig into it. Welcome to the show. I'm Jackie DeAngelis. Joining me today, Brian Sentland on the floor of the CME and my wingman Anthony Grisanti with me here at the NYMEX. Grizz, let's start with you. It's a bit of a puzzling situation today when it comes to gold. What is happening here?
Oh, absolutely, Jackie. Gold is taxing my thoughts here on April 15th, that's for sure. And it really, the down move is everything you had mentioned this morning. And there's one other thing I want to add. We got the D word out of Europe, deflation. And there isn't a commodity in the world that I know that doesn't like or that likes that word at all. So I think that's another thing that put pressure on the gold. But as you mentioned, the situation in Ukraine is still fluid, and the stock market is getting hurt. So I'm still looking at gold.
All right. Well, you're looking at it. And, Brian, also, when you talked about gold before, you mentioned there's a little bit of a catch-up period. Sometimes it takes investors a while to catch on, to really see that the market may be going down a little bit more than they expected and to flock into the gold trade. How long does that take before it happens?
Thank you.
Well, Jackie, I think it's a great point here because what basically you see here is as fear rises in the stock market, people get nervous. We've seen a nasty sell-off now over the last couple of weeks in the stock market. That catch-up period is about 4 weeks. You see a spike in the VIX or a harsh drop in the VIX. Gold tends to follow about 4 weeks later. So I think you're going to get that too. I think that psychology is going to come into the play here where investors are going to say to themselves, hey, the market's looking a little choppy here. Is it time for me to allocate my assets somewhere else? And I think gold will be that area right now. I think you used the drop in today to start to allocate that. I started to do that myself as well. I'm not saying go all in on the gold market here, but I'm saying it deserves a place in your portfolio the way the outlook is going in the overall global macro picture right now, Jackie.
All right, we'll talk about the dip. Certainly a buying opportunity today if you agree with that line of thinking. Let's stick with the gold conversation here and bring in our next guest. Paul Krake is founder of View from the Peak. Paul, always great to have you on the program. You heard what the gentleman had to say about gold. Our traders want to get your take on what you think is happening today.
Jackie, look, it makes me laugh people's attitudes towards gold because is gold an inflation hedge or a deflation hedge? And, again, you can argue we can't have the same argument that gold's going down on deflationary concerns, yet it should be spiking on the back of Russia. Look, again, what tends to happen with gold is it tends to be a very short-term safe haven asset in times of geopolitical risk. It tends to spike and then it goes back into whatever its preordained path was, based on primarily supply and demand, which is driven almost exclusively by central bank demand and gold, Indian and Chinese retail demand. Gold has no predictive powers at all. It doesn't predict or doesn't hedge inflation. It doesn't hedge deflation. It's simple supply and demand, and it shouldn't be classed as anything different than how we class other industrial metals.
All right, well, you're looking at an interesting chart that I want to pull up. You're looking at gold versus the MSCI World Index. What is that chart telling you right now about this trade?
Well, it tells you, Jackie, that gold has no predictive power. So the chart shows periods over the last 4 years where gold has acted like a risk asset, i.e. positively correlated to global equities, and there's periods when it's acted as a safe haven asset, which is times when it's negatively correlated to global equities. So all I'm saying is it beats to its own drum. There's no predictive powers there at all. Gold for most of last year acted like a safe haven asset, i.e. it was negatively correlated to stocks. But for the first 8 weeks of this year, it was positively correlated. So, again, I make the argument that we give gold too much credit for its predictive abilities, for its abilities to hedge during geopolitical events. And if you want a real hedge against a geopolitical event, look at the bond market.
Okay. All right. Well, let's leave it there for a moment, Paul, because I want to bring in our other guest who's been waiting patiently. Peter Schiff of Euro Pacific Capital joins us. Peter, what do you make of Paul's argument? Certainly, I kind of think I know what you're going to say, but go ahead.
Well, I don't make anything of it. I think it's an absurd statement to say that gold is not an inflation hedge. It has always been an inflation hedge. Currencies have been wiped out. People have preserved their wealth in gold for centuries. So to say that there's no store of value, there's no way to protect yourself from inflation by owning gold, something that central banks can't create, is absurd. But I'd like to talk more about what's going on with gold today. Because, you've got this big sell-off in gold today, and I think it's been driven by this phony idea that was floated by Goldman Sachs yesterday, and maybe the reporters picked it up today, that the Chinese are somehow not going to be buying as much gold in 2014. There is no evidence to suggest that whatsoever. In fact, China is probably going to buy more gold. What they're going to buy is fewer U.S. Treasuries. But, Goldman Sachs has been wrong on gold all year. We were at a 3-week high yesterday, and they're trying to talk the market down. But it's not going to stay down. Your viewers should be more worried about the NASDAQ than the drop in the price of gold.
Peter, I want to stick on this point that you're mentioning about China and the physical demand for gold, because that has been cited all morning as one of the reasons that we've seen it move lower. Paul, I want to get your take on that. What do you think about that? Do you think that's impacting the move today, or you think it's bigger picture stuff?
Peter, I don't think Jackie, Peter and I would agree on much on gold, but I think we're in agreement that Chinese demand is only going one way. Look, as real incomes rise in China, they will buy more gold. As real incomes rise in India, they will buy more gold. And my point about gold as an inflation hedge is you can have arguments both ways. But is gold an inflation hedge or a deflation hedge? Because gold bugs will give you both arguments.
It's an inflation hedge. I mean, if you think paper money is going to gain value, then you don't want to own gold. If you think paper money is going to lose value, then you want to own gold. And that's why I own gold. I've owned it for over a decade because central banks are printing money. And I think a lot of the demand for gold from China is going to come from diversifying their reserves. It's going to be the Chinese government. People are talking about money supply growth slowing down in China. It's not the new money printing that's financing the gold buying. They are moving their $4 trillion of reserves from paper to gold. The new money they print, that finances the treasury bond buying. And maybe one of the reasons that Chinese money supply isn't growing as fast is because they're not buying as many treasuries. And that's good for China.
Peter, look, the reality is that gold buying by the Chinese central bank, by the PBOC, is incremental. Money supply growth in China is quicker than any other developed economy on earth. To say it is slowing means it's slowing from a very, very high base. I think retail demand for gold in China...
I'm not arguing with that.
Retail demand from China is much more relevant than central bank demand. So I think we both agree that retail in China and that there will be a diversification. There are cultural reasons why the Indians and Chinese buy gold regularly. It's ingrained in their culture.
Well, you mentioned that the Chinese government is printing a lot of money. That is inflation. And so the Chinese citizens want to hedge themselves from that inflation, and they buy gold. And more and more people around the world are going to want to protect their wealth from central banks.
Peter, let me ask you this about the inflation hedge piece of the argument that you're making. Obviously, a lot of people make that argument as well, and they do hold gold in their portfolio. But at the same time, with the Fed spiking the punch bowl, as you have said, we have not seen the inflation emerge the way people have expecting. That's part of the reason that they've dumped gold.
They are spiking the punch bowl with inflation. That inflation is the expansion of the money supply. Quantitative easing is a euphemism for inflation. All the central banks are inflating. That's what they're doing. That's inflation. Looking at the effect of inflation as measured by the government's CPI index is meaningless.
Right, but we talked about this last time. The market isn't really looking at it that way. The market doesn't see inflation.
No, but the gold market doesn't care about the CPI. It cares about real inflation. This is all government propaganda trying to convince us that we don't have inflation.
Peter, you are so far off base. Chinese CPI, whatever measure you want to look at. Peter, you're miles off base. Chinese CPI is at multi-year lows. European CPI at multi-year lows.
You're not even in the ballpark.
Developed market CPI is its lowest level since October 2008. To say there is inflation, to say there is pricing pressure globally is incorrect.
No. How do you know, but how do you know where prices in China would be if the government wasn't printing all this money? Maybe prices would have gone down by 10%. But because they didn't, there's massive inflation. A productive economy lowers prices. Lower prices are the result of economic growth. And if prices aren't falling the way they're supposed to, if consumers are denied the benefit of falling prices because governments have created inflation and stolen that benefit away from them, you can't say there's no inflation. In the meantime, all the money printing distorts economies, it blows bubbles, it leads to all these misallocations of capital and resources. It does tremendous damage to the economy.
Gentlemen, I want to jump in here for a moment, Paul, and actually I do want to come to you and talk about the safe haven aspect of gold that you mentioned before. Yep. Obviously, the tensions in Ukraine are escalating. If you heard our trader, Brian Stutland, before, he was saying that he anticipates the gold buyers will come into this market because not only do you have tensions abroad, but you've got an equity market that looks and appears like it's slipping. The safe haven aspect, you don't think that investors are buying into that anymore? And if that's the case, How low do you think gold can go?
Look, I think, Jackie, that gold tends to spike in times of geopolitical risk. And again, there will be buying of gold if the situation with the Ukraine does deteriorate. I think it is unsustainable. Look, my base case for gold going to $1,000 over the course of the next 12 months is predicated on global rising real interest rates. That's the main reason why gold will go down, because if it is the safe haven asset that people claim it is, and the world is a less risky place, and I think you only have to look at where credit spreads are trading, etc., to see that, then gold doesn't really have a place in portfolios, just as we're going to see yen weakness, Swiss franc weakness, and weakness in developed modern markets.
Yeah.
All right,
you know,
Peter, summarize your thesis and what's your target?
Yeah, you know, I've been buying gold for over 12, 13 years. I've been recommending it to my clients, gold stocks. Not once have I bought gold because of geopolitical risks. I have never even considered that. You know, people that talk about that are the people that don't buy any gold. I've been buying gold for the same reason for the last decade, and it's because central banks are creating too much money, there's too much inflation, interest rates are too low, and so I want to store my purchasing power in something that central banks can't print. Well, meanwhile, during that time period, gold has gone from under $300 an ounce to a high of $1,900. We've pulled back. I think we're headed much, much higher because they are not going to stop these presses. They are going to run them in overdrive.
How much higher, Peter? How much higher and in what time frame?
I don't know the time period. They're just going to trend higher. They're going to go a lot higher. I've said $5,000. They'll go higher than that. I don't know how much higher the price is going to go. And, of course, in different currencies, depending on how much inflation, I'm more bullish on gold in terms of dollars than I would be on the Chinese currency.
But you yourself have told me on this show that you think the Fed is going to continue with quantitative easing. If anything, stop the taper and have to do more easing. If that's the case, then the market continues to go higher and nobody's going to want gold.
If the Fed continues with their taper and ends QE, we will be back in a recession. The stock market will be in a bear market. The real estate market will be in a bear market. And then what is the Fed going to do to respond to that? The only thing it could do is print more money and restart the presses and do more QE.
Peter,
the entire phony recovery in the market is based on the Fed. The Fed can't leave the game.
Peter, how do you justify the following? Last year you had the greatest balance sheet expansion across global central banks in history, yet gold had its worst performance in 30-odd years. Under your logic, that shouldn't make any sense.
No. Well, look, do you ever trade anything, buy the rumor, sell the fact? Gold rallied for over a decade in anticipation of that. It finally had a pullback. We shook out some of the weaker players. Meanwhile, gold is outperforming all the other assets in 2014. Everybody was writing its obituaries, including Goldman Sachs, at the end of 2013. Gold's going up. We don't know where gold's going to be at the end of the year. What if gold is at 2,000 or 3,000 next year? What are you going to say then?
Well, I don't think it'll get there, so I don't think we'll be having that discussion.
Well, did you think it was going to get as high as it did? What were you saying about gold? What were you saying about gold in 2004 and 2005 when it was $400 and $500 an ounce? Were you saying it was going to 1,000, or were you saying it was going down?
I didn't have a view on gold back then because I have the same views that I have now, that it is purely about supply and demand primarily. But, Peter, to make the argument, that it's buy the rumour, sell the fact justifies the greatest move in 30 years versus the greatest balance sheet expansion in central banking history is a bit of a lame argument. I'm sorry.
All right, gentlemen, we are going to have to leave it there.
Have to look at the bigger
appreciate
trend. There are counter
everybody's
moves.
point
Nothing
of view.
goes up
Peter,
in a straight
I'm out
line,
of time.
gold.
Peter, thank you. I really appreciate it, but we're out of time here. Paul, thank you so much for your views. Certainly, definitely a couple of different ways to look at the gold trade, and there's a lot of people out there who would agree with many of the points that you both made. So, gentlemen, thank you so much. Meantime, I do want to get to the trade aspect of this because I know that, Anthony, you are watching this. I want to take a look at your gold trade. What do you make of what they're saying and what you think gold is going to do in the short term?
Well, Jackie, at points, Paul was talking both sides of the coin here. He was saying gold prices are determined by demand from central banks. And then when we got to China, he said, well, it's not demand from central banks in China. It's demand from individuals in China, demand from India and in China. And why is it demand from India and why is it individuals in China and India? It's because they don't trust the central governments. That's why. So continuous buying is going to go on there. I think, when you do look at weak equities, you're going to see gold prices go higher. And certainly geopolitical reasons to own gold are there right now, especially with the Ukraine and everything else. This situation situation could break bad or even worse than it is right now very easily. So I still want to buy gold. I'm looking at $12.95 to buy the June contract. I put my stop in at $12.79, and I'm looking for a move up to the 13.32 or 13.22.24 area.
Yeah, Grizz, I think it's a great levels here, Grizz. I think I like these. I would even be willing to jump in right now, to be honest with you. I think you can allocate a little bit to your portfolio, maybe 5% of your portfolio. I'm not saying go all in on gold right now, but it makes sense to own it. The stock market is somewhat broken a little bit.
All right, guys, we are going to have to leave it there. Of course, we've got two bulls on the side of the gold trade here. Let's summarize what Grizz said. He is buying gold at $12.95. He's targeting a bump up to $13.22. Since each point counts for $100, this trade risking $1,100 to make $2,700.